2018 was a rough year. So rough that no major asset class outperformed inflation. And you can see in this chart next to me that this data goes all the way back to 1901. 93% of assets had a negative return. That is crazy high. Cash was actually king, and it only had a small 1.8% nominal return. This does not happen often, and we actually haven't seen it happen in the last 19 years. So what caused this rough year? Why did it happen? Well, one big reason is because of the Fed and interest rates. I'll explain why in this episode of Real Vision's The One Thing. What's going on, investors? AK here. The first thing we got to talk about is why interest rates even matter to the stock market. So bonds and stocks, they actually compete with each other for capital flows. And that means that stocks end up being valued relative to bond yields. Higher interest rates work to compress equity multiples. Because if interest rates are high enough, then investors don't want to mess around with stocks because they could jump into bonds, which are much safer, and still get a good return. So higher rates actually suck liquidity or demand out of risky assets like stocks. This is why Stan Druckenmiller always says how important it is to watch the people who control the rates, aka the Federal Reserve. He said earnings don't move the overall market, it's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. Most people in the market are looking for earnings and conventional measures, but it's liquidity that moves markets. The Fed manages short-term interest rates, or the front end of the yield curve, which if you don't know what I'm talking about, go back and watch our previous yield curve video. But as you can see here, when they raise rates, usually into strength, that causes money to flow out of stocks and into bonds. So stocks end up falling, and it's the same pattern over and over. And today, as they're raising rates into strength again, we're starting to see the stock market fall. The Fed determines when to raise rates based off inflation and unemployment, which is their dual mandate. So during the late stages of an economic cycle, when we're at or near full employment, that's when the Fed is going to shift from supporting the economy to controlling inflation, which is when they start raising rates. And here's Druck explaining it again. Once an economy reaches a certain level of acceleration, the Fed is no longer with you. The Fed, instead of trying to get the economy moving, reverts to acting like the central bankers they are and starts worrying about inflation and things getting too hot. So it tries to cool things off, shrinking liquidity. We pretty much saw the Fed turn against us in the beginning of 2018. Unemployment was below the natural rate and inflationary pressures were building up in the system. The rate of change in inflation actually spiked in the beginning of the year, mostly because of the oil rebound, so the Fed decided to try and cool things off. Here's a graph showing that spike. Core inflation rose to 3% or so, which signaled the Fed to go on their rate hike path. This whole thing becomes a circular feedback loop too. A spike in the rate of change in inflation increases expectations of a hawkish Fed, which drives yields higher. And then those rising yields causes volatility in the stock market because money starts moving out of stocks and into bonds where it could get that better return. But once money flows into bonds, raising their prices and stabilizing their yields, because you know, as bond prices go up, yields go down. Less money flows out of stocks because those yields aren't rising as fast anymore, so both areas stabilize. But the whole thing becomes a constant competition between stocks and bonds for capital. This is why the rate of change in yields pretty much follow a sine wave pattern. Here's the rate of change in the corporate bond yields, and you can see it moves up and down because stocks and bonds are competing for investors' money. So at the beginning of the year, we saw the rate of change in yields get pretty high, which made bonds more attractive relative to stocks. And so people started selling stocks and going into bonds, which helps start the sell-off. So clearly it's important to track where yields are going to see where the stock market is going. And since the Fed plays such a key role in determining what those rates will be, you always got to keep an eye on them to see what they might do next. And if you want help doing that, make sure you subscribe to Real Vision. I'll see you next week.